What's the most expensive financial disaster in American history before 2008? If you said the Great Depression, you're close, but you're missing a crucial, catastrophic piece of the puzzle. A piece that has been surgically removed from our collective memory. We remember the breadlines of the 1930s. We feel the aftershocks of the 2008 housing collapse every day, but sandwiched between them is a monumental, decade-long crime scene. A slow-motion financial heart attack that cost the American people not millions, not billions, but over $160 billion. That's the equivalent of nearly $300 billion today. This is the story of how an entire sector of the American economy, over 1,000 banks, vanished into thin air. It's a story fueled by a toxic, almost alchemical mix of good intentions, economic shock, radical deregulation, and brazen, jaw-dropping fraud. And the most chilling part of this story, we were told after it was all over that it could never happen again. But the clues, the patterns, the very human flaws of greed, fear, and arrogance that caused it, they never left. They simply evolved. This is the story of the savings and loan crisis, America's forgotten financial disaster. Strap in. Music shifts to a slightly more optimistic 1950s-era tone. Perhaps a snippet of a cheerful, vintage jingle that then fades into the background. To understand the sheer scale of this collapse, we first have to understand what was built. And to do that, we need to travel back to a different America, post-World War II. The GIs are home. They're starting families, buying cars, and dreaming of a single, powerful symbol of success. A house. A house with a green lawn, a white picket fence, and a shiny new car in the driveway. But how do you finance that dream? The answer wasn't a giant, faceless Wall Street bank. The hero of this story was a humble Main Street institution called the Savings and Loan, or, as your grandparents might have called it, the Building and Loan. Picture it, a small office on the corner, maybe next to the barbershop and the diner. The manager knew your name. These weren't for-profit corporations in the way we think of them today. Many were mutually owned, meaning they were owned by their depositors. Their mission was simple, almost noble, and beautifully straightforward. Take the savings deposits from people in the community, the butcher, the teacher, the factory worker, and lend that money right back out to their neighbors to buy homes. They were the circulatory system of the American dream, taking the lifeblood of local savings and pumping it directly into local homes. For this to work, they were kept on a very short, very safe leash. They were heavily regulated by the federal government. They could only pay a low, fixed interest rate to savers, regulated by Regulation Q. And they were largely restricted to making long-term, fixed-rate mortgages. They were boring. They were safe. They were predictable. And for decades, this system worked flawlessly. The S and LS were the engine behind the suburban explosion of the 1950s and 60s. They helped build the neighborhoods that defined a generation. America was prospering, and the S and L was its quiet, reliable bedrock. But beneath this placid, prosperous surface, a fatal design flaw was quietly ticking away. A vulnerability so critical that when it was finally triggered, it would shatter the entire system. And in the late 1970s, that trigger was pulled. The storm that hit America in the late 1970s was an economic hurricane. It arrived in two devastating waves. First, inflation. It didn't just rise, it spiraled into the double digits, a phenomenon dubbed the Great Inflation. Driven by oil shocks from the Middle East and years of expansive government spending, the cost of everything was going through the roof. The value of a dollar was evaporating before people's eyes. It felt like the economy was coming unglued. Enter Paul Volcker, the towering, cigar-chomping chairman of the Federal Reserve. His solution was radical, painful, and necessary. To kill the cancer of inflation, he had to strangle the economy. He cranked up the federal funds rate, the interest rate at which banks lend to each other, to unprecedented, almost unimaginable levels. We're talking about pushing it to nearly 20% by 1981. This was the sledgehammer that smashed the S and L model to pieces. Let's break down why. Because this is the core of the crisis. Remember those boring old rules. S and LS were forced by Regulation Q to pay a maximum of 5.25% interest to their savings customers. But suddenly, thanks to Volcker's rates, Anyone could walk into a brokerage and buy a treasury bill or open a money market account paying 12%, 14%, even 15%. Imagine you're a saver. You have $10,000 in your local S&L, earning a measly 5%. You see an ad for a money market fund paying 14%. That's not just a better return, it's a financial imperative. You'd be leaving thousands of dollars on the table if you didn't move your money. And move it they did. A silent, massive bank run began. It wasn't with panicked crowds outside branch doors. It was with quiet slips of paper and phone calls to brokers. This phenomenon has a name: disintermediation. It means the middleman, in this case, the S&L, was being cut out. Billions of dollars were electronically vacuumed out of S&L accounts across the country. But the crisis was a double-edged sword. While S and LS were bleeding deposits from one side, they were hemorrhaging cash from the other. They were sitting on trillions of dollars worth of long-term, 30-year mortgages they'd issued in the 1960s and 70s at low, fixed rates of maybe 5% or 6%. So do the math. They were earning a steady 6% on their assets, the old mortgages. But to try and stop the bleeding of deposits, they were suddenly forced to pay 12% or more on their liabilities, the deposit. They were locked in a financial nightmare, earning pennies on the dollar while having to pay out dollars on the penny. For every mortgage they held, they were losing money. The entire industry was, in financial terms, underwater. By 1982, over half of the nation's 3,200 savings and loans were technically insolvent. Their liabilities exceeded their assets. The system wasn't just cracked, it was shattered. The government was facing a monumental problem, and it was at this critical juncture that they made a fateful and ultimately fatal decision. Confronted with an industry-wide collapse, the government had two choices. Option 1. The painful but prudent path. Acknowledge the insolvency, shut down the failed S and LS, pay off the depositors, which would have cost an estimated $25 billion at the time, and learn from the mistake. But there was option 2. The gambler's choice. Double down. The idea, championed by a powerful S and L lobby and lawmakers who dreaded a taxpayer bailout, was seductively simple. If the problem is that S and LS can't make enough money, then just let them make more money. Let them get into more profitable, riskier lines of business. They could, in theory, earn their way out of the hole. So in 1982, with bipartisan support, President Reagan signed the Garn-St German Depository Institutions Act. This wasn't just a tweak to the rule. It was a radical, fundamental reinvention of the American S and L. It was the moment the boring, neighborhood building and loan was handed the keys to a financial casino. Overnight, the guardrails came off. The Garn-St German Act allowed S and LS to make commercial real estate loans, invest in junk bonds, directly invest in speculative development projects, make non-secured consumer loans, and most critically, it removed the cap on the interest rates they could pay to attract deposits. They went from being boring home lenders to high-flying, high-risk investment houses. And here's the kicker, the part that created the most perverse incentive imaginable. Federal deposit insurance was still firmly in place. The FDIC and the Federal Savings and Loan Insurance Corporation, FSLIC, guaranteed deposits up to $100,000 per account. For depositors, this meant there was zero reason to care what the S and L was doing with their money. It was 100% safe, no matter how crazy the bets were. For the new, aggressive owners moving into the industry, the message was clear. Heads, I win. Tails, the taxpayer loses. The stage was set. The regulations were gone. The safety net was wide open. And into this new Wild West stepped a new kind of cowboy. This is where the story shifts from a tragic financial miscalculation to a systemic moral collapse. The deregulated environment didn't just attract savvy businessmen, it sent up a flare for every opportune, reckless, and outright criminal operator in the country. They saw a system perfectly engineered for exploitation. A new business model emerged, so notorious it earned a nickname from regulators: the killer rabbit. The strategy was simple and devastatingly effective. Step 1, attract hot money. You couldn't rely on local savers, and so you'd offer the highest interest rates in the country for brokered deposit. Professional money managers would scour the nation for the best rates and funnel hundreds of millions of dollars from their clients into your S and L. This wasn't patient local capital. This was a volatile torrent of cash, ready to flee at the slightest hint of a better offer. Step 2. Bet the farm. Now, sitting on a mountain of this hot money, you had to generate enormous returns to pay the exorbitant interest rates you'd promised. So, you went for the riskiest, most speculative investments you could find.